Hello everyone, and a very warm welcome to the latest Irwin Mitchell quarterly tax webinar. Our title today is Tax Planning in Turbulent, Uncertain Times, and I'm sure that you'll all feel that turbulence and that uncertainty of the moment. It is extraordinary, but we hope to put that extraordinary into a bit of context. And so here is the panel that we have for you today. I'm pleased, I'm privileged as, my name is John Bunker, and I'm privileged to be your chairman today and to be introducing you to one of the partners in our estate planning team, Naomi Neville, who runs our team in the Chichester and Southampton offices, and Jessica Fazzone, who's in our international and high net worth team in the London office, one of our associate solicitors. Our fourth member of the panel, Ellie Gibbison, sadly can't be with us because she's not well this morning, so I'm going to be picking up what she was going to say. But those are your panel, and it's our pleasure to be with you today. Just to give you a bit of housekeeping, it's really good you can be with us, and we hope that you'll find this really helpful. There will be recordings sent out at the end. If you have any questions to ask, two things. If you're listening live, please put the questions in the Q&A panel, and we'll be pleased to try and pick those questions up as we go along. If you can also give your email address in case we don't get a chance to answer it today, and then we'll come back to you afterwards. And then if you're listening on the replay, please do send your questions to me, and then between us we'll try and answer those questions after the event. Towards the end, we'll give you a feedback form, which we'll be very pleased if you complete, because it's always helpful to get your sort of feedback of what was good and what worked and what didn't work so well. So, trying to learn, because we love sharing this, these seminars, these webinars with you, but we will always value your feedback. Okay, let's look at our agenda, and I'm going to try and put the tax cuts and the U-turns and everything that's happening with Jeremy Hunt as Chancellor into a bit of context and what it means for our clients. And then Naomi will be looking at business and partnership issues, talking about some of the 100% tax relief issues, but also picking up Trust Register, the TRS, which we're going to pick up also in variations. There's a couple of big changes that have been made to the Trust Register, which we think are relevant when you're looking at tax planning, to also take on board the Trust Register aspects. So Naomi will pick that up. I'll then pick up the variations issues that Ellie was, the slides that she's written, and then pick up a TRS issue on that at the end, and then we'll come to Jess to talk about international estate and succession planning and some of the questions there, including the question about EU succession regulations, which still apply even though we're not in the EU. So okay, let's get going then with my own subject here, tax cuts, U-turns, and what a great day to be delivering this, to be talking about all of this stuff. All of these slides were written yesterday deliberately, thinking that there could be last minute thing, not realizing that at 6 o'clock in the morning, Jeremy Hunt would actually be announcing that he'd be speaking at 11 to bring forward some of his changes. But let's look and see. So let's go to remind ourselves we've come a long way in the last few weeks since the fiasco of the mini budget on the 23rd of September. That was, of course, Kwasi Kwarteng when he was Chancellor, and 45 billion of unfunded tax cuts. And we've seen then 3 U-turns, the first on the 45% rate, the second on corporation tax on Friday when Kwasi Kwarteng was sacked. Then Jeremy Hunt's brought in, and he made a third U-turn yesterday with reference to the tax cuts. Obviously, loads of politics in that. That's not our concern here. Our concern here is the tax and trying to make sense of what's actually happening with the tax changes and what it means for clients. But a really important thing down the bottom, sorry, just to go back to the end of 1.1, the really important thing at the bottom of 1.1 is the medium-term fiscal plan, as it's now being called, is on the 31st of October. brought forward from the 23rd November. That was going to be a budget. Of course, some of that was put in yesterday. But the great thing with that is that that's the day when we will get the OBR, the Office of Budget Responsibility, reviewing the figures. And that was the big thing that was missing from the mini budget, was the OBR kind of sense checking of the figures. So that's really important. Going on then, I've tried to just summarise where we've come with the reductions to the unfunded tax cuts. What are we down to now? We're down to perhaps 20 billion or so, perhaps a bit less, because of the fuel subsidy, which is reduced to only 6 months. The reality is there is still a huge gap to make up, a huge sum which is unfunded. And Chancellor Hunt has said, both on Saturday and again yesterday, there may need to be tax increases. So I suspect we may get some tax increases on the 31st of October, as well as the spending cuts which are needed. But what I want to do is to take stock of what actually happened and what this means for clients. So on slide 1.3, we come to the two changes that have actually going through, and that's national insurance and SDLT. So the 1.25% extra on national insurance continues up until the 5th of November, but next month it comes to an end. So we will have 7 months of this year with the higher rate, both for employers and employees, the 1.25%. But then it stops. So for 5 months this year, we won't have that extra 1.25%. That was going to become the health and social care levy in April. That's not going to take effect, but watch what the position is with dividends, which I'll cover on the next slide, because that's something which we need to see in detail. SDLT, those changes took effect from the mini budget day, from 23rd September. And you'll see there the valuable increase in the threshold from 125 to 250, and also the improvements for first-time buyers relief. Those things they were needed anyway, perhaps, but they were particularly needed when you see the effect of the fiasco with the budget and the effect on interest rates. And a lot of you paying mortgages will be feeling the effect of the increase in interest rates on mortgages. One final point on this slide to note is this is the SDLT change is said to be a permanent one, not a holiday, but clients might wish to buy now while stocks last, so to speak. If you're going to try and make the most of it, I wouldn't hang around. SDLT is a very easy tax for the government to collect money on, so I think it's well worth making the most of it while you can. The great thing with SDLT, of course, is that the lawyers and the conveyancers collect the tax for the government. So going on to 1.4, we then look at the changes which are not now going through, and the first is on the 1.25 on dividends. We had been told that would change in April, that was going to go from April, but it's not going. It is staying in place. So we have an extra 1.25 on dividends long term, and that's quite a significant thing because, as I say at the bottom of this slide, there's now a bigger tax gap between those who earn money via dividends and those who earn via salary. So a reminder of the figures on here. We've got the figures for the 3 rates of dividends. We've got the personal tax allowance and the also the national insurance allowance of 12,570, which is frozen. Again, it's frozen, so that's going to be a tax effect from that. And then the income tax rates, which will be staying at 20% indefinitely. They were at one stage going to be changing next year in 23. The original Rishi Sunak plan was 24, but no, we're going to stay at 20% longer term. Now, that's great from a calculation point of view. 20% is nice and easy if you're doing comps, but obviously the disappointing in some respects, but that's where we are, and one of the things needed to try and make the books balance. Okay, 1.5. What's the impact of this upon clients' tax planning? Well, obviously the first 2 words on my slide here are still fundamentally important. There's great uncertainty. Even while we were preparing these slides, there was still great uncertainty. But I think if you stand back from this, if you take a bigger perspective and have a look at this, we can see that a lot of people, including a lot of baby boomers, a lot of my generation and above, are doing relatively well. You know, the burden in the last year has been on working age people with national insurance, and although we've still got the dividends added in, it's worth observing that nothing extra was being paid towards health and social care by people who have, you know, really good pensions, and a lot of our clients have got really good private pensions, and, you know, the gold-plated kind of schemes which have all stopped now, but in their day they paid out really good pensions, and rental incomes. Nothing out of rental income was going towards health and social care. So, you know, some people have been doing very well. If you're retired on a good pension with property income, you've been doing quite well relatively. And so one of the consequences of the tax cuts we have had with the national insurance is that there will be higher net incomes this year and going forward for normal expenditure out of income gifts. So that's one thing to think about when we're looking at the numbers when we're doing inheritance tax planning. Okay, going on to 1.6, we need to talk about IHT and CGT, and this is where I talk about the stealth tax rises. Nothing's been said about these two taxes yet, and they are nothing. Their tax raising powers are nothing compared with the big four. You know, the big three: income tax, national insurance, and VAT, and the fourth biggest, which is corporation tax. But there is still a real stealth tax effect of these changes. IHT frozen for 5 years, another 3.5 years from now. You know, and nil rate band will have been frozen for 17 years by the end of that 5-year period. The residence nil rate band will have been frozen for 5 years, and that just means more tax is being paid by doing nothing. Likewise on CGT, the annual exempt amount, you know, that's frozen, and that does have a big tax raising effect. It's a real stealth tax. But if we go on to look at what that might mean for tax planning, what we come to on here is that just doing nothing means clients are paying more tax. As property values increase, so does a tax take. Now, I know there's going to be, you know, a lot of people are predicting downturns in property markets, and some of you may be seeing that already. But there's still been a lot of gains, and medium term, we still would expect to see gains in property values. And if you need a figure to give to clients, in red, I've given you the figures. If a client is being blasé about IHT, oh, I'm not worried about that, you know, it's, you know, well, why not quote to them the fact that in 5 years, the OBR are estimating an increase from 6.1 billion, a 1/3 increase with an extra 2 billion of inheritance tax receipts. A lot of people are going to be paying that extra £2 billion to contribute to that £2 billion of extra IHT. And this, therefore, could be a really good time for clients to consider lifetime gifts, to consider helping younger generations with the rising cost of living. And I go on my next slide to use a phrase which I saw in a paper 10 days ago, when in the I newspaper they talked about giving while living, which I think is a great phrase. And there's a phrase in the middle of this in red. Many retired people are gifting money to their adult children early when they need it most. And if any clients can be encouraged to help the younger generation, their children, their grandchildren, their nieces, nephews, great nieces, nephews, whatever, there is a real sense that some people who are doing okay have got an opportunity to review what they've got, what they need, and what they could give away. And as I say on this slide, through effective lifetime planning. We've got some increased incomes with normal expenditure out of income, but there are lots of things clients can do, and it is really worth looking at that to try and ensure that clients can help the younger generations where they can. My final slide for the moment is with regard to the Office of Tax Simplification, and I slightly lament the passing. I mean, assuming it is a passing, assuming they are going to be abolished as Kwasi Kwarteng had announced. The OTS had done 2 reviews of both IHT and CGT, and in my role with the CIOT, I sat in on meetings, or I led meetings with them to look at those things. And there's some really good thinking went into their reports. There are 2 significant things which the government's picked up. We've seen the change, number 1, simpler accounting for inheritance tax on death. And those of you who deal with accepted estates will seeing the effect of that. But can I focus on number 2? CGT on separation and divorce has been a real problem for some years, and this is the kind of technical tax issue which the OTS is absolutely there to actually bring about. We had the strange situation which we do still have this year, and this change proposed is only from next 6th of April. At the moment, it's not reflecting in this year that if somebody separates, they've only got the year of separation in which to sort out transfers between spouses on a no gain, no loss basis. The proposed change in the finance bill is a 3-year no gain, no loss window. The year of separation plus 3 years, and that's fabulous, absolutely fabulous. But why is it only from next 6th of April? So a final thought for you is, if you've got clients who are talking about separation, is it worth, if they are talking about that in January, February, March, is it worth hanging on in there until the 6th of April? And, even manufacture a few things, put some pictures on Facebook of how you enjoy going to the cinema together on the 6th of April. And then just a few days later, actually, it was just too much and the whole thing's come to an end and the marriage is over. There is a real potential here for CGT, which it sadly is only from the 6th of April. Anyway, there we are. That's my thoughts for the moment on those tax changes. I'm now very pleased to introduce my colleague in the Chichester office, Naomi Neville, who runs the Chichester and Southampton estate planning teams to talk about business and partnership issues.
Lovely, thank you, John. Good morning, everyone. On the first of my slides, I've summarised the 3 connected areas that I'm going to be covering in the next 15 minutes. The first is the use of estate planning to help clients maximise the availability of BPR, a little bit on APR as well. We're then going to move into will structuring for clients who have estates with business assets, and then finally talking a little bit about TRS and partnerships to the extent that this ties in with estate and tax planning. So on slide 2.2, I've highlighted some of the elements that my colleague and partner Christine Thornley covered in our last quarterly update. She mentioned the barriers to planning in lifetime where clients have business interests, discussing the difficulties that current owners sometimes feel in the emotional loss of their business, the loss of control, worries about potential demotivation of the younger generation working in the business or farm if gifts are made. And from a tax perspective, Christine also highlighted the impact of capital gains tax on lifetime giving and the loss of the double tax benefit currently retained if the assets are held until death, when the estate would benefit from both a CGT free uplift as well as hopefully 100% BPR or APR. And it's these difficulties that leave business owners, and particularly those with rural businesses, reticent to pass assets down generations during their lifetime. However, as John highlighted, we do want to encourage our clients to consider lifetime succession planning where they can. And even once they've taken advice, if they end up not making the lifetime gifts, this planning will help to ensure that their business structures are right to maximise available reliefs later. Slide 2.3 sets out where we should really start for clients who have businesses. We want to make sure that where no relief is currently available, we consider whether we can help our clients to secure BPR. This opportunity often arises in a mixed business that has both trading and investment activities. As most commonly seen in the modern diversified rural business. And if a business is not wholly or mainly trading, then BPR will be lost completely. It's an all or nothing situation. So when we need to consider to what extent a business is trading, we can use this in the round test that came from the case that's known as the Balfour test, to consider the balance of trading against investment in relation to the 4 criteria that I've listed on the slide. We can consider if a full restructure of the business might assist excuse me, in obtaining BPR over some of the assets, perhaps by hiving off investment business into a different structure. But that's quite a radical step, and for some clients that won't be right. But if we're fairly sure that a business will qualify for BPR, we can just strengthen the case by ensuring that the client is using consolidated accounts for the whole business rather than separating out investment from trading, and that management is involved in all levels and all aspects of decision making. It's also really important not to separate out records or decision making at all in respect of the 2 types of business, but make clear that the business is integrated as one whole element. But what if a business holds too much cash? At the worst, the cash, which is technically an investment asset, will increase the value of the investment side of the business, and that could be to the extent that BPR is lost completely. But at best, a business may qualify for BPR, but the excess cash would be an accepted asset, which would still increase the overall IHT exposure. And so if you're working with a business that has significant cash reserves, it's really worth making sure that the client is identifying the purpose for which this cash is held, and that they identify that purpose in the accounts each year, but they also record regular discussions and decisions about whether or not to retain the cash in their board or partnership minutes and the reasons for the retention. And if the cash is not really being saved for a specific business need, can we encourage the clients to spend it by investing further in the assets of the business? Turning to point 4 slide, this is sort of reiterating the point that John made, that this 100% relief is such a good thing. We really don't want to waste it. So one of the other things we can do for clients who are business owners is to look at the assets in the business which may only qualify at the 50% rate and see if we can improve that position. On this slide, you'll see that I've set out the categories of assets which only qualify for BPR at the 50% rate. The first of these doesn't come up very often in practice, but I've included it for completeness. The second category in bold here is more likely to offer some planning opportunities. The 50% relief here is available regardless of whether or not the partnership or company pays rent to the individual owner, but is potentially more generous to partnerships than to companies, as only a controlling shareholder who personally owns an asset used by the business can benefit from the 50% relief, whereas any partner can benefit from 50% BPR if they own assets which are used in their business. If your client is a partner and owns assets personally which are in partnership use, or if personal assets are a controlling if personal assets of a controlling shareholder are used by their company business, then there may be merit in considering transferring that asset into the partnership or company. And there may, of course, be other tax implications of such a restructuring, particularly SDLT and CGT, to balance against potential IHT savings. And our role is to help our clients identify opportunities for improving the IHT relief position, but at the same time considering the other tax costs of making such a switch. And of course, the availability of the relief is still contingent on satisfying the ownership condition and the wholly or mainly test. While the wholly or mainly test shouldn't be affected by this sort of shifting of assets around suggested, it should be thought about. And we also need to bear in mind the rule that allows a spouse to inherit the ownership period of their spouse on death doesn't apply to transfers between spouses during lifetime. So any movements of assets around, any planning of this kind, it's important to consider 2-year term life assurance potentially to cover any additional tax that would arise in the event of a death in that period. And this relief at 100% is so valuable that it's crucial to find ways to help clients claim the highest rate of relief possible. There are opportunities for us as professional advisors to provide input, working as a team for our clients to consider taxation as well as advising on the commercial implications. For example, is it worth exposing an asset to trading liabilities? It's also key for professional advisors not to lose sight of the fact that the business may not just be an asset for tax planning purposes, but is very likely to be a significant part of our clients' lives. 2.5 covers a small point that's linked in respect of APR. So similarly, if we are advising farming and rural landowning clients who have businesses which do qualify for APR, it's worth checking again to ensure that as much of the value benefits from 100% and not just 50% relief. And 100% relief is far more generous now than prior to September 1995, when only in-hand farmers who occupied land themselves would benefit from full APR. All land let on tenancies which began after the 1st of September 1995, that the business farming tenancies, receive the extended 100% APR benefit. But in addition, since 2006, it's been possible for land let on a pre-1995 tenancy to benefit from 100% APR by replacing the old AHA tenancy with a new tenancy while retaining the tenant's security that was provided by that old regime. So if we are working with clients who let land under arrangements which haven't been updated since before 1995, which those of us who are involved in rural work will know this is more common than you might expect, there are opportunities to improve the relief position and mitigate against IHT. And again, we do need to guide our clients through the other tax costs of these restructures, usually in this case SDLT, but possibly also CGT if concessions don't apply. Turning to 2.6, this is just a brief mention about will structuring, really. And as John mentioned before, with the OTS looking set to close, it does seem now a bit more remote that the trading threshold for BPR will end up being raised, as was suggested, from 50% to 80%. However, as the title of this webinar implies, that the tax landscape remains incredibly uncertain at the moment, and so there's merit in making sure that the wills of business clients, and particularly those who are married or in civil partnership, make use of the reliefs currently available sooner rather than later, i.e. not on first death leaving everything outright to the surviving spouse, because that would then rely upon both the CGT free uplift and BPR or APR being available on second death for tax efficiency. So what can we do? Using a trust on first death for the nil rate band amount that is also defined as including any business assets specifically named in the will, and also more generally any other assets which qualify for BPR or APR is ideal, as that not only secures the reliefs at the earliest opportunity, but it also keeps the option open for the survivor benefiting if needed from that trust, and also allows for some post-death planning, potentially to allow a second bite of the cherry on the second death if we can move things around and reuse the relief at that time. And finally, moving to 2.7 and introducing the TRS and how it works with partnerships. One of the things that's sort of unique about partnership in business structure is that it does not have legal personality of its own, and therefore partnerships can't hold property in their own right. And because of this, partnership property is often held by either one or a number of the partners, but for the benefit of the whole partnership. And where property is purchased using partnership money, but is held in one partner's name or more partners, but not the whole partnership, the Partnership Act introduces a general presumption that that property belongs to the partnership as a whole, without the creation of an express trust. And because of this legislation, many advisors have taken the view that TRS isn't something that businesses in partnership need to worry about. But as with all things TRS, the actual legal position is far from simple and merits further consideration with each of our clients. If there is a written declaration of trust, and by that I mean either a clear standalone deed or something as simple as a clause or statement in the partnership agreement, which confirms that property is held on trust for the partnership, this is an express trust which will be registrable on TRS unless we can find that any of the other exclusions from registration apply. And this is not always very clear, as is obvious from the updated guidance in the TRS manual, which was added at the 20th of July this year. The reference to the relevant page in the manual is on the slide. But the example on that page is Guy, Yasmin and Esther, where Guy's purchase of machinery does create an express trust which is registrable on TRS from the date of purchase, provided there are no other exclusions from registration. And that's because the wording in the partnership agreement was as set out on the bottom of the slide here. It stated that property purchased by a partner using partnership funds is to be held for the partners in equal shares, and that is considered to be an express trust. So there is clear need for us as professionals to review partnership asset ownership carefully to see if TRS applies. And that involves looking at the wording of any partnership agreement and also considering each asset type separately to see if the exclusions might apply. It may be relatively obvious for land, but less obvious for property such as cars or other machinery where the registration isn't so formal. An example of an exclusion is, for example, where 4 partners hold land on behalf of the rest of the partnership. That doesn't need to be registered because although it is an express trust, it's one that's imposed by legislation because it's not possible for land to be held by more than 4 legal owners. But to continue to be excluded, we need to have 4 partners owning the land. And therefore, if one partner dies or leaves the partnership, that would trigger registration. So it's really important that we keep that up to date. Moving on to 2.8. It is sensible for all partnerships to consider together with their legal and tax advisors the content of their partnership agreements and how they hold their property and other assets, cars, machinery, plant, etc., to determine firstly whether their existing arrangements give rise to a need to register on the TRS, and then if it does, is a change of practice feasible or even desirable as a way of reducing the ongoing compliance burden. Obviously, there may be other costs in changing that practice, and it may well not be desirable to try and avoid registration. For example, it doesn't seem sensible to rely on a partnership at will purely to avoid TRS registration. And so in practice, registration may well just be the lesser of 2 evils. But certainly we flag this as a significant and potentially a bit curious factor for clients and advisors to consider, as I think many people would not think about partnerships as falling within the description of a trust. And moving to my last slide, 2.9, I started this part of today's session outlining how we as professionals can support our clients in maximising the availability of reliefs, perhaps by bringing personally owned assets into the business to increase the percentage at which assets are relieved. And just before I finish, I want to flag that if any of us are assisting clients with this, an implemented plan may result in a need to register for TRS for the first time. TRS should really therefore now be considered as part of any estate planning activity, so we can help our clients to be proactively compliant. And as often business clients have more than one advisor, I think it's worth saying that it's really vital that we as advisors don't just assume that someone else is going to pick up the TRS position with our clients. And it's always far better for a client to hear the same message about TRS multiple times from all of their advisors than for one of us to forget to mention it and end up negligent for failing to have advised. So on that happy note, back to John to continue. Thank you.
Thank you very much, Naomi. That's great. And now I come to the slides which my colleague Ellie Giverson has prepared, and I'm sorry she's not able to be with us. So if we start with her first thoughts on deeds of variation and important point, really important point, that it is not a substitute for a will. It doesn't do everything that a will can do. There are problems with it. I mean, it is something to use. A variation is a really important thing to be able to go to if the will is not in the most effective form and the client wants to restructure things in a different way. It will mean, Section 142 of the Inheritance Tax Act will mean the reading back to the date of death, and that will help to achieve certain objectives, but there are some different tax treatments, as we'll see later, and it is not the same as doing a will, and it's always better to do a will if you can. There are other issues that may arise if you rely upon a variation. So it's basically the 2-year timescale that applies both to 142 and also to Section 144, the variations of trusts. One important point to note is that with 144, where you're rearranging a trust, that is an automatic thing. It doesn't need to be chosen. It will happen, and you need to be careful if you're rearranging a trust that might affect. It might be read back to date of death in any event, just automatically. Whereas with 142, you choose that, you put that into the deed. So going on, let's look at some of the great reasons and how the deed of variation can be a great planning tool. As Ellie says here, there is more magic than you think. So her top 10. First of all, the original beneficiary may not need the gift. They may have their own IHT problems, or there may be very good reasons why they'd like to make a gift that is from the deceased rather than being taxed for inheritance tax as a gift by them. It may be possible to redirect, number 2, to redirect an inheritance into a disabled person's trust. And there was a case a couple of years ago on this where the Court of Protection authorised that because of the advantages of a disabled person's trust. But you've got to remember who the settlor is, and if you're giving it away, there's all the issues about deprivation of assets, and hence the involvement of the court in certain cases. Ascertaining the residence nil rate band, that it can be a really good way to crystallise the RNRB, to give a specific gift that makes sure we use the RNRB on the death, and also to avoid bunching of estates. Many of you will be familiar with the £2 million threshold that we can get a phasing out, a tapering loss of the RNRB over 2 million. So we want to actually using it on death actually avoids that happening on the second death. Number 4 is the APR and BPR point of banking the relief, getting it, making sure you've got it, following on from what Naomi has said, in case there are changes, either because there are changes in the law and the way it's structured, and the way that the business doesn't qualify for technical reasons by that stage, or because you simply sold the business or the farm by the time of a later death. So that's really important to be able to bank that. Number 5 on the next slide is the great point about the nil rate band discretionary trust and the value of that for flexibility, and a great tool for most spouses to have in their wills, and among other things, the flexibility to cope with changes in legislation. And number 6, if you've got somebody who's remarried, there is the real problem about the fact that the nil rate band, as indeed with the residence nil rate band, can only be carried forward up to a maximum of 100%. If you've had somebody who's been married a couple of times, that they can only have 100% carried forward. So actually, it is a case, as I say on here, of use it or lose it. You've got to make sure you use it, otherwise it may be lost completely. Avoiding a grob, number 7. The reservation of benefit rules are horrible, as many of us will find in day-to-day practice. So negotiating the reservation of benefit rules is important, but this is a great thing where you can remain a beneficiary of, for example, a discretionary trust, while taking it outside of your estate. So not just for spouses with the nil rate band, but for anybody, it is a way of keeping your options open. being a beneficiary but taking it out of your estate, because the discretionary trust is treated for inheritance tax as if it was created by the deceased. The redirection of charity gifts, number 8. You may be familiar with the 10% of the net estate which can go to charity and then reduces the inheritance tax rate. It gives a lower rate of inheritance tax from 40% to 36%. It's really, really valuable, and actually it's not used as much as it might be. So a deed of variation could take you in two specific situations. One where at least 4% has been given. You can go up to 10% and actually save tax, actually be better off. The residue can be, the saving of tax can mean that the residue is actually greater than it was before. Or if you're exactly 4%, you can go up to exactly 10% and there's no change in the amount of the residue. So really worth doing. Number 9, there's a technical situation where you might see an increase in the value of the estate, and you may manufacture a cash legacy to the spouse, and then leave the residuary estate to the children, and that can work in certain cases very effectively. Finally, number 10. The rules of intestacy often don't produce the results you want, so it can be very useful to be able to just rearrange those and vary them into a better form. Then very quickly on slide 3.4, the other tax issues, just to say CGT, you've got the option whether you use it or not. You can have it read back to date of death so that the new beneficiary or the trust that takes it on at probate value as a base cost. But you don't have to. It's a separate thing from the IHT, and you can choose not to use the CGT reading back. But there's no reading back for income tax. That is going to be just changing from the date of the deed of variation. That's the date that the right to income changes. There's no reading back. Okay. Final slide on the TRS aspects, and wanted to just flag up for you this important point that was, the amendment was brought out in August that said that if you've got a variation which creates a new trust, and that new trust may simply be a bare trust for a beneficiary who's absolutely entitled. Now, if that is created either by a section 142 variation of an estate or 144 variation of a trust, either way, you don't have the normal 2-year rule you have for estates with paragraph 7 of the schedule for the TRS. Paragraph 7 talks about trusts affected by will. If there's a variation, it's no longer affected by will. So unless there's another exclusion, you have to register that within 90 days of the variation, even if that trust is a simple bare trust for someone who's absolutely entitled. So I do feel anybody who's doing the planning advice needs to also consider and advise on the TRS position here. It's obviously something we'll pick up, but as Naomi was saying, always better to be told twice than not at all, because the TRS points can get missed because it's so complicated and so in some cases difficult to understand or justify. And just on the justification point, here I've got 2 different situations. If you're creating a substantive trust, for example, an occupation of a property, then clients will quite understand that that needs to be registered. But why does an outright gift, which might be, for example, a cash legacy under a deed of variation, why does that need to be registered as a new trust? And that's where you may need to refer to the TRS manual as the authority to say this does need, we've given you the reference here, this does need to be registered within 90 days of the date of the variation. So that's enough on variations. And now a chance to introduce my colleague from our London international and high net worth team, Jess Fazzone, who will talk to us about international estate and succession planning. Thank you, Jess.
Thank you. Thank you, John. Hi, everyone. So I'm going to talk about the key issues to consider when looking at cross-border succession planning. And I've got their succession and tax issues, and as we'll also talk about the EU succession regulations, which are also known as Brussels IV. We'll then have a look through an example which will highlight these issues, and then I'll briefly comment on corporation tax in relation to FICs, family investment companies, IR35 rules, and offshore investment bonds in relation to the TRS. So, first, I'm going to highlight the key issues which should be considered when dealing with international and high net worth clients, and why it's important to keep these issues in mind. In relation to succession, it's important to look at domicile, because your domicile status will impact succession as well as tax. HMRC is raising more and more domicile inquiries, and so it's important for a client to keep their domicile under review, and where necessary to seek domicile advice in relation to the steps they should take to strengthen a non-UK domicile claim, or to understand the consequences of potentially becoming UK domiciled at common law. The status of assets and whether the assets are movable or immovable will impact the succession rules that apply. So again, it's important to understand this key point in order to properly advise clients in relation to their cross-border estates. Then very key is each country has its own succession laws which will govern who can inherit. This is important as some countries have forced heirship rules, meaning that a portion of the estate is reserved for a spouse or children, for example. The EU succession regulations, known as Brussels IV, were introduced to allow individuals to apply the law of their nationality to the succession of their assets, where otherwise forced heirship rules would apply. So, for example, a British citizen could elect for English law to apply to their Spanish assets to get over forced heirship rules in Spain. However, in my next slide, I'll talk a bit more about the complexities with Brussels IV and some updates on that. And these succession issues will, of course, impact how wills are drafted and whether separate wills are required to govern specific assets in other jurisdictions. Then we have issues with inheritance tax and taking into consideration whether an asset will be taxed in two jurisdictions. If so, we need to consider whether the UK has a double tax treaty with that country, specifically in relation to inheritance tax. And if not, we look at unilateral relief. And I've also added there as a sort of bullet point that it's important to consider who exactly is to inherit. For example, where there are stepchildren, whether they are treated for tax purposes in the same way as a biological child, which again, I'll explain further in my next slide. So the easiest way to discuss these issues is basically to go through an example. So here I've got Mrs. B. So Mrs. B is a French national. She has been UK resident for 18 years. She is married. She's on her second marriage. She has a child from her first marriage, which is her biological child, and she has a stepchild, being the child of her second husband. So using the same heading sort of as before, I'm going to start with succession. So Mrs. B has a French house. This is an immovable asset, so we need to consider how she can pass this asset on to her intended beneficiaries. The property here is in France, so under French law, France applies Brussels IV. Now, Brussels IV, whilst the UK was not a signatory, it still applies to us, and so there's been no impact on its application since Brexit. So very much still applies to the UK. So under Brussels IV, the basic rules are: the succession law that applies is the law of the state in which the individual was habitually resident at the date of their death, unless they were closely connected to another state, or they've chosen to apply the law of their nationality as the law that applies to the succession. So in our example here, it is the place of habitual residence, so England, that will apply, as Mrs. B here has not chosen the law of her nationality to apply. Under English private international law, which is the law that decides which jurisdiction's succession law applies, we distinguish between immovable assets and movable assets. So the succession of immovable property is determined by lex situs, and the succession of movable property is determined by the law of domicile. So here we have immovable property, so lex situs applies, which refers the matter back to France. So French succession law would therefore apply. The issue we now have is that France has forced heirship. which could apply the property in a way which is contrary to Mrs. B's intentions. It's worth noting here that in 2021 in France, it was ruled that if French assets were to pass in accordance with the succession laws of a country which does not itself have forced heirship rules, so for example, in England we don't have forced heirship rules, then protected heirs, so children for example, can make a claim for the share they would have been entitled to under the French rules, but they can only take this share from French assets. So taking our example, if Mrs. B was a British citizen and made an election in her will for English law to apply and left her French assets to, for example, dog charity, so getting around forced heirship rules and disinheriting her children could bring a claim in France and be paid their share out of the French assets. Now, this basically overrides Brussels 4. So it's something to bear in mind when dealing with French assets, and we're sort of waiting to see if there'll be any claims brought and some cases in France to see this in application. I should also note that in our example, if Mrs. B applied for British citizenship, so potentially an estate planning option, she could have made an election for English law to apply to the succession of the French property. But we just need to be careful if we're looking at advising clients to acquire citizenship, because there could be tax consequences, and there are tax consequences involved in that, and the impact that that would have on domicile. So fourth slide, please. Now moving on to inheritance tax. So Mrs. B is UK deemed domiciled. She's been in the UK 15 out of the last 20 years. So we'd want to consider whether she could be UK domiciled at common law. Her worldwide assets, they will be subject to UK IHT. As the asset here that we're talking about is in France, it's French. It's a French property. France will seek to tax it. I should add here actually that France will tax the beneficiaries whilst the UK taxes the estate. This is really key to bear in mind in terms of, in England, we tax the estate and have executors that deal with the estate on behalf of beneficiaries. But in France and other jurisdictions, it is the beneficiary who is responsible for the inheritance and associated tax. So just going back to the tax, the UK would actually give a credit for the French IHT paid here. So that would eliminate the double taxation of the French property. Now, as I mentioned earlier, it's the beneficiaries that are responsible for the tax. So we need to look at who the beneficiaries are. And in France, stepchildren are treated like non-relatives. So they're treated in the same way that a friend would be treated if it was a friend inheriting the French property, for example. So the inheritance would be subject to a higher tax rate of 60%. And this can be compared to, for example, a biological child whose inheritance would be taxed at a maximum rate of, I believe it's 45%, depending on the value of the inheritance. So again, super important to understand the family, and do question where a client may refer to a child as their child, but in fact they are a stepchild and not a biological child, as this is really going to impact the estate planning here. I've already sort of mentioned looking at domicile, so you'd also perhaps consider preparing a separate will if appropriate, and consider any French estate planning options to minimise inheritance tax exposure. Bear in mind that we need to consider where clients are taking advice in other jurisdictions, whether there could be a tax impact in the UK. So for example, usufructs, which are a great tax planning tool in France, might not be such a good structure from a UK tax perspective. And if we have a UK domiciled individual, it's really important to look at this, because if they do set up a usufruct in France, for example, during their lifetime, they might be creating a lifetime trust in the UK subject to the relevant property regime. So always sort of UK tax consequences to consider when advising international clients and when dealing with their foreign assets. So hopefully that's highlighted a number of issues to consider when dealing with sort of cross-border estates, and highlights how we work with other advisors and to give the client a sort of holistic approach to their estate and succession planning. So I'm now going to move on to give some final comments on corporation tax, IR35 and offshore investment bonds. So corporation tax, last week there was a U-turn on the mini budget's announcement to keep corporation tax at 19%. So as it now stands, we're going to return to the original proposal to increase it to 25%. So from April 2023, the UK corporation tax rate will increase to 25% for companies with a profit over 250,000. For profits below 50,000, you've got the small profits rate of 19%, which will apply. And then for profits between 50,000 and 250,000, there'll be a gradual increase in the effective rate of corporation tax. The key thing to note here is the small profits rate or the gradual increase in the effective rate will not apply to closed investment holding companies, which by definition includes family investment companies. So family investment companies will, from April 2023, be subject to 25% corporation tax. Now, family investment companies will still remain a useful vehicle for succession purposes, and the tax rates are generally more favourable than trusts. And then just moving on to IR35. The current IR35 rules are going to continue to apply. They were going to be repealed, but we've done a U-turn on this too as of yesterday. So the current IR35 rules continue to apply. I was just going to say, and I'll say it sort of regardless, had we sort of returned to the previous IR35 rules and had the current ones repealed, employers would still need to be careful, because if the company is aware that the contractor should be treated for tax purposes as an employee, then the company could be facilitating tax evasion. So there's just something to be aware of in terms of corporate sort of criminal offences. And then offshore investment bonds in relation to the TRS. You need to consider whether an offshore investment bond needs to be registered in more than one jurisdiction. So you might have the case, as for example, how we've got the example there in the bullet point, that if you had, for example, an Irish offshore bond held in trust which needs to be registered with the UK TRS, you may also need to register it elsewhere, and in our case it would be with the Irish Central Register of Beneficial Ownership of Trusts. So it's something to just be mindful of, where you may need to register in a second jurisdiction as well as the UK, and often the information is the same. So that is me wrapped up on my sort of final comments, and I'll pass you back on to John. Thank you.
Thank you, Jess. That's great. We're coming up towards our hour. We may just run over slightly. We've got time for a couple of questions. If you have a question, please do put something in the chat box just now, or as I said before, if you want to send it to me, then I can see if one of us will get back to you with an answer. But just to say, before we get to the questions, thank you very much for joining us. It's been great to have you with us. We hope you will join us for future Irwin Mitchell webinars and the regular tax updates that we do. We have sent out a link for you to the feedback form, which would be really grateful if you could complete, because we do value your feedback on what we've covered today and how we've done it. So thank you for that. Could I first of all just ask a quick question of Naomi? Naomi, you mentioned in a will making a gift of specifically named business assets into a nil rate band discretionary trust on the first death. Would you still do this even if you aren't sure of getting business property relief on the specific asset?
Yes, great question. Thank you. We would still recommend doing that. The reason really for naming the asset specifically, rather than just relying upon a general gift of assets which qualify, is because if you've got in the nil rate band trust, you've got your nil rate band amount, you've got assets that you know qualify for BPR because you've said in the definition that it's only assets which qualify for BPR. And then you've got residue to spouse. That is an estate that won't be paying any tax. And because there's no tax to pay, HMRC will not usually comment on whether they agree that BPR is available or not. Whereas if you make a gift of, say, all my shares in family company X or whatever your company is called, and you're not sure if they qualify for BPR or not, you're going to have to enter into a discussion with HMRC about that, and they will then consider it and form a conclusion. And that then knowledge about whether you're getting BPR or not is really, really helpful when you're going forward and planning for the second death.
Thanks, Naomi. That's great. I'm feeling a bit left out here. So I haven't got a question myself, but Jess has got a question, so we'll put that to Jess. So, and I think unless anyone's got anything else, that may be our last question. But would you cover worldwide assets within a UK will, and maybe with an election for English law to apply?
Thanks, John. So, I guess if you were going to cover this, this is one of the key planning points, which is, do we cover worldwide assets within a UK will? And the EU succession regulations were introduced to make this easier. However, hopefully, as I've highlighted, it's still quite tricky. Often we need to consider what the assets are. So if, for example, I sort of sound a bit obsessed with France, but if the assets were in France, we need to be careful because, for example, the French do not like trusts. So if we're covering French assets in a UK will that has, for example, a discretionary trust or life interest trust, for example, that might be difficult to explain to French advisors and for France to therefore deal with that asset. So in those circumstances, it would probably be advisable for a client to actually prepare a foreign will. So prepare a will in France covering the French assets and then deal with a UK will dealing with only UK assets. It sort of depends. It's one where you have to just look at all the assets that are involved and what we're covering and where they are.
Thank you very much, Jess. Lovely. Okay, we've just run a couple of minutes over, but hopefully that's not the timing's worked well for you and that you found this helpful. Thank you very much for those of you who've joined us and for those of you who are catching up on the recording. The recording will be sent out to you, and I hope you'll find that helpful and that we've given you a few ideas. As Jess was saying in her talk, one of the things we love doing is working with fellow professionals to give better solutions for clients. So if there's anything we can help you with, please don't hesitate to get in touch. And we hope to see you again at another Irwin Mitchell webinar in due course. And thank you very much for your time today. Okay, all the best, everybody. Thank you.